Hi everyone. This is a lecture of Monetary and Financial Economics B2. This is the fourth lecture. So today we will cover International Monetary Systems, Part 1. So today we will cover these three contents: macroeconomic policy goals in an open economy, classifying monetary systems, the open economy monetary trilemma, and international macroeconomic policy under the gold standard. Okay. Now move on to the first topic, macroeconomic policy goals in an open economy. So there are two macroeconomic policy goals. First one is internal balance, full employment of a country's resources and domestic price stability. Full employment and price stability is the internal balance. Okay, the second one is external balance. A country's current account is neither so deeply in deficit nor so strongly in surplus. So current account balance. So the balanced current account is like external balance. So macroeconomists, so policymakers try to balance the internal balance and external balance. Sorry. Okay. So about external balance, there are no ambiguous benchmarks to apply to an economy's external balance. So there are only unclear benchmarks to apply to an economy's external balances. Policymakers generally adopt some current account targets as an objective, so which is called external balance goal. So current account target is generally not zero, avoiding huge external surpluses or deficits. So note that external deficit or surplus is not a bad thing. So this is a result of trade or financial transactions. But huge imbalances, huge deficits or surpluses often cause problems. So therefore, policymakers try to avoid huge imbalances, huge deficits or surpluses. So a current account deficit means that the economy is borrowing from abroad. The current account deficits can be large due to high consumption resulting from misguided government policy, etc., or investment based on over-optimistic expectations about future profitability. So in such case, the current account deficits can be larger and sometimes repayment is harder. So in such cases, countries may have trouble in meeting their payments. So foreign creditors become reluctant to lend them new funds and may even demand immediate repayment of earlier loans, so which is called a situation sudden stop in foreign lending. So sometimes countries with large current account deficits may have trouble meeting their payments. Therefore, foreign creditors stop to lend them new funds and may even demand immediate repayment of earlier loans. So therefore, if such sudden stop happen, then the borrower's economy collapse. So therefore, policymakers in countries with having large current account deficits try to prevent sudden stop in foreign lending. So excessive current account surplus is also problematic. A current account surplus means that a country is accumulating assets located abroad. So the current account is surplus by reflecting low domestic investment for a given level of national savings. So recall this equation. Saving is equal to the current account plus investment. So domestic saving can be divided into current account and investment. If given the level of national saving, domestic saving is large current account surplus means that low domestic investment. So this is problematic. Why? The policymakers prefer domestic investment because of several reasons. So the first reason is it's easy to tax the return from domestic capital. And the second one is leading to lower, so the domestic investment leads to lower unemployment and higher national income. And the third one is domestic investment by a firm has a technological spillover to other domestic firms. So therefore, policymakers prefer domestic investment. So a large current account surplus may be inconvenient for political reasons. Some countries with a large surplus can be target for discriminatory import barriers. Recall that Japan vs. United States trade war in 1970s. So in 1970s, Japanese car is very productive. Japanese car was very productive, and Japanese Japanese car producers export many cars to US. Then United States stated to impose discriminatory import barriers to Japan. And then Japanese export were down, decreased. Okay. So a country with a large surplus can be a target for discriminatory import barriers, like Japan. Okay, classifying monetary systems, the open economy monetary trilemma. So monetary trilemma is the impossibility of a country having more than two items from the following list. First, exchange rate stability or fixed exchange rates. Second, monetary policy oriented toward domestic goals. Three, freedom of international capital movements. So these three cannot be achieved together. So economies or the country has to give up at least one item. So for example, in chapter 18, fixed exchange rate countries giving up number 2, monetary policy for domestic economy. So this is the illustration of monetary trilemma. Exchange rate stability, monetary policy for the domestic economy, and the freedom of international capital movements. These three things cannot be achieved together, okay? Country must give up exchange rate stability or monetary policy for the domestic economy or freedom of international capital movements. Country must give up at least one thing, one item, okay? If the exchange rate stability is gave up, if a country give up exchange rate stability and country gets monetary policy for the domestic economy and freedom of international capital movements, then this country is floating exchange rate system. Okay, if a country gives up exchange rate stability and get monetary policy for the domestic economy and the freedom of international capital movements, then this country is floating exchange rate system. If a country give up monetary policy for the domestic economy and get exchange rate stability and freedom of international capital movements, then the country is fixed exchange rate system. Or the country is a member of currency union like EU. So the currency union and fixed exchange rate system gives up monetary policy for the domestic economy. Notice that in EU, each country doesn't have own domestic central bank. So in EU, the member country does not have own central bank. Instead, they have a common central bank, ECB. So therefore, they gave up monetary policy for the domestic economy. And the last one is the country giving up freedom of international capital movements and gets exchange rate stability and monetary policy for the domestic economy. In this case, the country faces financial controls. So including emerging and developing countries. So emerging and developing countries imposes financial controls, giving up freedom of international capital movements, and gets exchange rate stability and monetary policy for the domestic economy. Okay, this is the monetary trilemma. Okay, now move on to the last topic. I guess it's last. Okay, international macroeconomic policy under the gold standard in the next video.